Question 6. Which of these kinds of property would be excluded from being covered by the community property rule? A. Property acquired or held by one of the spouses prior to the marriage. Property acquired during the marriage by a gift or inheritance from a third party. C. Property acquired during the marriage by using resources, usually money, that are not community property. D. All of the above. Correct answer is D. All of the above. Community property laws generally apply to property acquired during the marriage through the efforts of either spouse. The following are typically excluded. A. Property acquired or held by one of the spouses prior to the marriage. Property owned before the marriage remains the separate property of that spouse. B. Property acquired during the marriage by a gift or inheritance from a third party. Gifts and inheritances received during the marriage are considered separate property, as they weren't earned through the efforts of either spouse. C. Property acquired during the marriage by using resources, usually money, that are not community property. If separate property funds are used to purchase an asset during the marriage, that asset generally remains separate property. For example, if a wife uses inheritance money, separate property, to buy a car, the car is her separate property. Question 7. A lease in which a party rents a property from the owner and then subsequently leases out the property to another tenant is called A. Turnaround lease, B. Sandwich lease, C. Secondary lease, D. Boomerang rental. Correct answer is B. Sandwich lease. Turnaround lease, secondary lease. Boomerang rental isn't a formally defined legal term in real estate. A sandwich lease occurs when a tenant subleases the property to a third party. The original tenant becomes the sublessor, and the new tenant is the sublessee. The original tenant is sandwiched between the landlord and the sublessee. Question 8. California's financial disclosure laws include the following, except A. Mortgage loan broker law, B. Seller financing disclosure law, C. Truth in Lending Act, D. None of the above. Correct answer is C. Truth in Lending Act. While the Truth in Lending Act, TILA, is a significant financial disclosure law, it's federal law, not specifically a California financial disclosure law. California has its own set of financial disclosure regulations. The other options are examples of California-specific disclosure laws. A. Mortgage loan broker law. California's mortgage loan broker law requires specific disclosures to borrowers in mortgage loan transactions handled by brokers. B. Seller financing disclosure law. California law mandates disclosures when a seller provides financing to a buyer. The Truth in Lending Act, otherwise known as Regulation Z, is a federal law. Question 9. The tax assessment roll, showing the assessed value of each property in an area, would be used to A. Set the tax base for the area. B. Calculate the proportionate share due from each property. C. Determine the tax rate. D. Equalize the taxes paid by the area's property owners. Correct answer is A. Set the tax base for the area. A tax assessment roll is a public record that lists all taxable properties within a specific jurisdiction, like a city, county, or school district. These individual values are then totaled to arrive at the overall tax base. This total assessed value is a crucial component in calculating the tax rate. It's divided into the amount of revenue the taxing authority needs to raise. It's a fundamental document used in the property tax system. It is the official inventory of properties for tax purposes. Question 10. A person who purchases an existing promissory note will become a holder in due course if the note is A. Complete and regular in appearance and form, BB, without a notice that it is overdue, dishonored, or claimed by another person. C. Purchased in good faith for valuable consideration. D. All of the above. Correct answer is D. All of the above. The phrase "a holder in due course" is a legal term that refers to someone who possesses a negotiable instrument, like a check, promissory note, or bill of exchange, in good faith and for value. This person has certain rights and protections that a regular holder might not have. A holder in due course is someone who meets all of the following requirements when they receive a negotiable instrument. Lawful possession of the instrument. They must have legal ownership of the instrument, which may be due to a transfer from the previous holder or receipt from the issuer. Giving value. They must give something of value in exchange for the instrument. This shows the holder's good faith and ensures that they are not receiving the instrument unfairly. Good faith. They must receive the instrument in good faith, without knowledge or any reason to suspect any issues with the legality of the instrument or the rights of the transferor. Timeliness. They must receive the instrument before it is due, if applicable. No notice of defects. They must be unaware of any defects of the instrument, such as it being stolen, forged, or disputed. Why is being a holder in due course important? A holder in due course has greater rights than a regular holder. The main advantage is that they can typically enforce payment on the instrument even if there were certain defenses that could be used against the original person who was supposed to be paid. Example: imagine someone writes a check but then realizes they were tricked into writing it. If the check ends up in the hands of a holder in due course, the bank will likely still have to cash the check, even though the person who wrote it might have a valid reason for not wanting to pay. In summary, a holder in due course is someone who takes a negotiable instrument in good faith, for value, and without notice of any problems. This status gives them special legal protections and the right to enforce payment on the instrument. Question 11. The act of recording a deed provides A. Constructive notice of ownership, B. Actual notice of ownership, C. Proof of ownership, D. An ownership lien. Correct answer is A. Constructive notice of ownership. Recording a deed in the public records provides constructive notice of ownership. This means that the law presumes that everyone is aware of the recorded deed, even if they haven't actually seen it. It's as if the information is out there and accessible to anyone who checks the records. This is different from actual notice, which is direct knowledge of something. A lien is a claim against a property for a debt. Recording a deed does not create a lien. It documents a transfer of ownership. Liens are separate legal instruments. Question 12. All of the following events will serve to terminate an offer except A. The offeror dies. B. The property is destroyed in a fire. C. The offeree rejects the offer. D. The offerer moves to another state. Correct answer is D. The offerer moves to another state. An offer can be terminated by several events, effectively ending the offerer's ability to accept it and form a contract. Moving to another state has no bearing on the validity of the offer. Unless the offer has a specific time limit, it theoretically remains open until it is formally revoked, rejected, or one of the other terminating events occurs. Question 13. One who provides an agent with authority to represent their interests dealing with another party is called an A. Principal, B. Primary agent, C. Title company officer, D. Escrow agent. Correct answer is A. Principal. A principal is one of the main parties to a transaction. For instance, the seller and buyer are considered the principals in a real estate property sale. A person who hires a broker to represent them in a property transaction is a principal. The agent acts on behalf of the principal in dealings with third parties. The relationship is based on trust and agency law. Question 14. A real estate broker can obtain a real estate license under a fictitious name if A. It is not misleading or would amount to false advertising. B. The name does not imply a non-existent corporation or partnership. C. It is not a name previously used by a licensee whose license was revoked. D. All of the above. Correct answer is D. All of the above. Real estate brokers can operate under a fictitious business name, also known as a DBA, doing business as, but must adhere to specific rules to ensure transparency and avoid misleading the public. All the conditions listed are typically required. A. It is not misleading or would amount to false advertising. The fictitious name cannot misrepresent the nature of the business or mislead consumers. B. The name does not imply a non-existent corporation or partnership. The name shouldn't suggest a business structure that doesn't actually exist. C. It is not a name previously used by a licensee whose license was revoked. This prevents brokers from trying to resurrect a tarnished reputation by using a previously revoked business name. The license name can also not include the word escrow or imply that the licensee is offering escrow services. Question 15. If a broker does not include a termination date in an exclusive listing, which subsequently results in a paid commission, then the broker may A. Have his license suspended or revoked, B. Lose the listing, C. Have his commission forfeited, D. Be prosecuted for fraud by the Attorney General. Correct answer is A. Have his license suspended or revoked. A real estate licensee who undertakes an exclusive listing must comply with several obligations detailed in California Business and Professions Code, Section 10176. In many jurisdictions, including California, real estate licensing laws require exclusive listings to have a definite termination date. Failing to include this date is a violation of these regulations. While the broker might still be able to receive a commission if the property sells, the lack of a termination date puts their license at risk. Serious or repeated violations can lead to legal action. Simply omitting a termination date in an exclusive listing is unlikely to rise to the level of criminal fraud. It's more likely to be handled as a licensing violation by the real estate regulatory agency.